Understand the business. Business model. Understanding a company's business model is crucial to evaluating its long-term viability. Start by dissecting how the company generates revenue. This involves analyzing its primary sources of income, whether it's through direct sales, subscription fees, or service contracts. Assess whether the revenue streams are diverse or concentrated in a few areas. A sustainable model is typically one that adapts well to market changes and consumer demands. For example, companies with recurring revenue models, such as subscription-based services, often have more stable financials. Evaluate the company's operational processes and whether they contribute to or detract from profitability. A robust business model not only withstands economic fluctuations, but also positions the company for growth. Competitive advantage. A competitive advantage is what sets a company apart from its competitors and helps it maintain a leading position in the market. This advantage can take several forms. It might be a strong brand that fosters customer loyalty and allows the company to charge premium prices. Cost advantages, such as economies of scale, can enable a company to produce goods more cheaply than competitors. Unique technology or intellectual property can provide a barrier to entry for new competitors. Examine whether the company possesses one or more of these advantages and how they contribute to its market dominance. A durable competitive edge is essential for long-term success, as it protects the company from competitive pressures and market volatility. Industry position. To fully understand a company's potential, you need to place it within the context of its industry. Determine how the company stacks up against its peers in terms of market share, financial health, and growth prospects. Consider the overall health and growth trajectory of the industry itself. A company in a growing industry may benefit from broader market trends, while one in a declining sector might face more significant challenges. Evaluate factors such as industry regulations, technological advancements, and consumer trends that could impact the company's performance. Understanding the company's position within its industry provides insight into its growth potential and long-term sustainability. Focus on financials. Revenue and profit growth. Analyzing a company's revenue and profit growth is essential for assessing its financial health and performance over time. Start by reviewing the historical data on revenue, which indicates the company's ability to generate sales. Consistent revenue growth suggests a strong demand for the company's products or services. Similarly, examine profit growth, which reflects the company's ability to manage costs and expenses effectively while increasing sales. Look for trends in both metrics over several years to understand the company's financial trajectory. Sustained growth in revenue and profits is a positive sign, but be wary of short-term spikes that might not be indicative of long-term performance. Margins. Profit margins provide insight into how efficiently a company is operating. They are calculated by dividing profit by revenue and are expressed as a percentage. Key margins to consider include the gross margin, operating margin, and net margin. The gross margin reflects the percentage of revenue that exceeds the cost of goods sold, highlighting the core profitability of the company's products. The operating margin accounts for all operating expenses, giving a clearer picture of overall operational efficiency. The net margin, which considers all expenses, including interest and taxes, shows the company's bottom-line profitability. Comparing these margins to industry peers helps gauge how well the company performs relative to competitors. High or improving margins typically indicate efficient cost management and strong market positioning. Balance sheet. Strength. The balance sheet is a snapshot of a company's financial position at a specific point in time. It lists assets, liabilities, and shareholders' equity. Start by examining key metrics such as debt levels, which reveal how much leverage the company is using. High levels of debt relative to equity can be a risk if the company faces economic downturns or cash flow issues. Assess the company's liquidity by looking at current assets versus current liabilities to ensure it can meet short-term obligations. Metrics like the current ratio and quick ratio provide insights into the company's ability to manage short-term financial challenges. Also, evaluate the company's asset quality and whether it has enough assets to cover its liabilities. A strong balance sheet with manageable debt and healthy liquidity indicates financial stability and resilience. Valuation matters. Intrinsic value. Determining the intrinsic value of a stock involves calculating its true worth based on fundamental financial analysis. One common method is discounted cash flow, DCF analysis. This approach estimates the value of a stock by projecting the company's future cash flows and discounting them back to their present value using a discount rate. The DCF model requires assumptions about future growth rates, profit margins, and the risk-adjusted discount rate. By comparing the intrinsic value derived from this calculation to the current market price, investors can assess whether a stock is overvalued, undervalued, or fairly valued. Accurately estimating intrinsic value helps in making informed investment decisions, ensuring that the stock is purchased at a price that reflects its true worth. Price-to-earnings ratio. The price-to-earnings, PE ratio, is a widely used valuation metric that compares a company's current share price to its earnings per share, EPS. This ratio provides insight into how much investors are willing to pay for each dollar of the company's earnings. To use the PE ratio effectively, compare it to the company's historical PE ratios and those of its industry peers. A higher PE ratio might suggest that the stock is overvalued relative to its earnings, while a lower ratio could indicate undervaluation. Additionally, consider other valuation metrics, such as the price-to-book PB ratio and price-to-sales PS ratio, for a more comprehensive analysis. These comparisons help to gauge whether the stock's price is reasonable in the context of its earnings performance and market conditions. Margin of safety. The concept of a margin of safety is crucial for protecting against potential valuation errors and investment risks. This principle involves buying a stock at a price significantly below its intrinsic value, providing a cushion against unforeseen market fluctuations or errors in financial projections. The margin of safety acts as a buffer, ensuring that even if the company's future performance falls short of expectations, the investment still has room to remain profitable. This approach reduces the risk of loss and enhances the likelihood of achieving a favorable return. By incorporating a margin of safety into your investment strategy, you can safeguard against uncertainties and make more prudent investment choices. Management quality. Track record. Evaluating the management team's track record involves assessing their historical performance and experience in steering the company. Start by examining the backgrounds of key executives, including their previous roles, achievements, and the overall impact they've had on the company. A proven track record of success, especially in similar industries or business environments, indicates strong leadership capabilities. Look for evidence of past accomplishments, such as successful turnarounds, growth achievements, or innovation initiatives. Additionally, consider how the management team has navigated challenges or crises in the past. A management team with a solid history of making sound strategic decisions and delivering results often signals a higher likelihood of continued success. Strategy. Analyzing the company's strategic plans involves reviewing its long-term goals and the effectiveness of the strategies implemented to achieve them. Start by evaluating the company's vision and mission statements to understand its overall objectives. Examine the strategic initiatives and business plans put in place, such as market expansion, product development, or cost reduction measures. Assess whether these strategies are coherent, realistic, and aligned with the company's goals. Look for evidence of strategic adaptability, where the company adjusts its plans in response to changing market conditions or competitive pressures. Effective strategy is not only about setting ambitious goals, but also about executing plans efficiently and measuring progress toward those goals. Integrity. Assessing management's integrity and transparency is crucial for ensuring that they act in the best interests of shareholders. Start by evaluating the company's communication practices, including how openly they share financial information and address shareholder concerns. Look for signs of honesty in financial reporting, such as adherence to accounting standards and the absence of restatements or questionable practices. Transparency also involves how management handles corporate governance issues and conflicts of interest. Assess whether there is a clear and consistent approach to ethical behavior and decision-making. Management with high integrity will demonstrate honesty, fairness, and a commitment to upholding shareholder interests, which builds trust and contributes to the company's long-term stability. Long-term perspective. Investment horizon. Adopting a long-term investment perspective is fundamental to achieving substantial returns and weathering market fluctuations. By focusing on a horizon that spans several years or decades, you allow your investments to benefit from compound growth. Compounding refers to the process where the returns on an investment generate their own returns, creating a snowball effect that accelerates growth over time. This long-term view helps investors to stay invested through market ups and downs, avoiding the pitfalls of short-term volatility. Embracing a long-term investment horizon also allows you to invest in fundamentally strong companies that may take time to realize their full potential, thereby maximizing your opportunity for significant gains. Patience and discipline. Maintaining patience and discipline is essential for adhering to your investment strategy amidst market noise and emotional reactions. Investing requires a steady approach, especially during periods of market volatility when emotions might tempt you to deviate from your plan. Patience involves resisting the urge to make impulsive decisions based on short-term market movements or speculative trends. Discipline entails sticking to your investment criteria, regularly reviewing your strategy, and making adjustments only when they align with your long-term goals. By adhering to a well-considered investment strategy and avoiding knee-jerk reactions, you position yourself for more consistent and sustainable success. Regular review. Regularly reviewing your investments is crucial for ensuring they continue to align with your financial goals and adapting to changing market conditions. Set intervals, such as quarterly or annually, to assess the performance of your investments and evaluate whether they are meeting your expectations. Consider factors such as changes in company fundamentals, shifts in market trends, or alterations in economic conditions. Regular reviews allow you to make informed adjustments to your portfolio. Rebalancing is needed to maintain your desired risk and return profile. Staying informed and responsive to new information helps you to remain proactive in managing your investments and ensures that your long-term strategy remains on track.